Hey, how's everybody doing out there? It's Alexander Investment Insights. We're back with another video, and this is going to be a video on blue chip stocks. We're going to go over a few blue chip stocks in this video, and if you don't know what a blue chip stock is, it is a growing, reliable, high value company that has had continuous reliable growth over many years, and they're usually well-known companies as well. So they're usually pretty good for long-term investing. If you want to hold them for, let's say, 10 years plus, you just want to make sure that they're having stable earnings, revenue, earnings per share growth as well. So let's go over some blue chip stocks, and then the first is going to be Apple. Apple is heavily weighted in the S&P 500 and a lot of indexes. Berkshire Hathaway. That's because Apple is heavily one of the biggest consumer electronics companies in the world. And if we go out to this monthly chart, look how it's been ever since 2000. Boom, from all the way from below $1 a share up to above $200. These type of conglomerates are hard to take down. Next blue chip stock, Meta. Let's zoom out. Meta having phenomenal growth, starting around 2012 under $20 and now is above $500. These are huge. Meta is a huge social media company, an online platform, right? Amazon, one of the biggest electronic retailers in the world. If we go to its monthly charts, booming. These reliable growths, and on these down movements, you don't sell during these times. These times happen all the time. If you actually look, there's always some down movements, like Netflix. See? Boom, down, but it's such a big conglomerate company that it comes right back up because these companies that have so much revenues and growth and assets and other things that they have under it. Let's go to other blue chip stocks, right? Nike. Zoom out on Nike. Continuous growth. Continuous growth. Let's go to AT&T. We zoom out. Continuous growth. This is have a higher dividend, but it is still a blue chip stock. Let's go to Microsoft. Continuous growth. Massive growth. You see there was pull downs here. Pull down. But it always recovers. Pull down. Recovery. Massive companies that are very hard to take down. Disney. Zoom out. Continuous growth. 20 years ago, Disney, 2024, 2004 was at $20. Now its high was over $200 and it's at $100 right now. Let's go to Walmart. Walmart 20 years ago was under $20. Now it is above $60, but has continuous growth to the upside. Do you see that? Let's go to Oracle. Oracle, continuous growth 20 years ago. Oracle under $20, around $10. Now it is above $140. These are blue chip stocks. Avgo, Broadcom, continuous growth. 2010, 14 years ago, $14. Now it is above $1,700. These are big blue chip stocks. Datadog, relatively new company. This is maybe considered a blue chip stock because of the sector that it's in, but it really has to have more continuous growth than this. Let's go to other ones. Lululemon. Big continuous growth to the upside. Pull downs, but when it has pull downs, you see how it recovers to the upside. Dollar Tree, continuous growth, pull downs, but it recovers. Target, big growth, pull downs, but it recovers. Costco, big continuous growth, not many pull downs because it recovers fast. Berkshire Hathaway, continuous growth, pull downs but always recovers. Bank of America, not as of a big growing stock, but it has continuous growth, see, and it recovers. Let's go to MasterCard, continuous growth, it comes down, but it recovers. Selective Insurance Groups, continuous growth, it comes down but it recovers. Lockheed Martin, continuous growth, it comes down but it recovers. See how you should be getting a sense of these? You should know all of the companies that I'm talking about. CVS, continuous growth, it comes down but it recovers. These are huge companies that you use in your daily life. Caterpillar, it comes down but it recovers. So I could do this all day. There is a lot of big major companies that have a lot of just history behind them. McDonald's, continuous growth, has pull down, but it recovers. Pepsi, continuous growth, has pull downs but it recovers to the upside. 20 years ago Pepsi was at $40. It is now at $170. These are blue chip stocks, some that you should be going through and putting in your IRA if you don't only want to put it in the S&P 500. If you believe some of these blue chip stocks are going to have higher returns annual year to year than the S&P 500, then you could put some of these in your long-term portfolios. Chipotle, continuous growth and it recovers. Carnival Cruise Line, has growth and it recovers, is at low prices but it recovers for the most part to the upside. You could go through a lot of these companies that you know about. Boeing, continuous growth and it recovers. Chevron, continuous growth and it recovers. Dollar General, continuous growth and it recovers. So there's so much that you could go through. Ulta, continuous growth and it recovers. Foot Locker, not as much continuous growth, but you see how it does recover over time. Home Depot, continuous growth and recovers. So I'm just going to leave the video there. Since you've seen a lot of my watch list, you could keep going through those and just look up blue chip stocks and a lot of companies that you know about. Just write them down and put them on your watch list. That's how you grow your watch list, really just staying curious. So if you enjoyed this video and you learned more about blue chip stocks and value investing and long-term investing, then leave a like and subscribe to this video. And thank you. Bye.